This is the GTC Traders podcast, the markets, finance, the economy, and commentary. Nothing within this podcast should be viewed as an investing or trading recommendation. GTC Traders is not a registered investment advisor or advisory service. It does not tell or suggest which securities or derivatives should be bought or sold. Analysts, affiliates, employees, or partners of GTC Traders may hold long or short positions within the currencies, derivatives, securities, equities, or industries herein discussed. GTC Traders and Secundus Puer LLC assumes no responsibility or liability for any trading or investing results. Facts, statements, data, and charts posted to the company website or mentioned within this podcast may unintentionally include inaccuracies. Content is for educational purposes only, and outside independent advice should be sought to confirm the validity or accuracy of any statement or claim made. You should ask the firm with which you invest, trade, or deal about the specific terms, conditions, tax implications, and risks of specific markets, and the associated obligations that such trading may place upon you. You should always check with your licensed financial advisor and tax advisor to determine the suitability of any investment to your individual circumstances. No assumption should be made in relation to the performance or accuracy of the methods shown. No claims are made as to the success or profitability of any statements made.
What is going on with this guy anyway? What's going on with this company? What's going on with this brand? He's back. Dan's back. He's got this new company. There are partners. And the entries are a bit sporadic. And then there's another one. And then we don't hear anything for a while. And there's supposed to be some new playlists. And then we don't hear anything. What's going on here? Well, good day, everyone. This is Dan, and today is April the 26th, 2025. I thought we would have a podcast on sort of the state of things for GTC Traders. Let's talk about the state of things for markets and our thoughts on markets. I had one of the partners tell me, he says, those were in the past, in my previous sort of projects, he says, those were always my favorite podcasts. Was listening to sort of your take on the state of markets. And I really think you should do more of those. And I haven't been. So what's going on? So let's have a little podcast here. And what we're going to do is we're going to talk about the state of GTC Traders, maybe flesh out a few things for everyone, as well as the state of markets. Let's call it the state of things, okay? We're going to have somewhat the state of things. So we should probably start with GTC Traders and talk about the state of things with GTC Traders. Okay, I want to explain something, and I hope that it explains why maybe it seems like it's been sporadic on the public front with GTC Traders material and sort of what's going on under the hood a little bit behind the scenes. I don't want to reiterate something we've gone over a number of times, but I'm going to in order to illustrate a point, okay? GTC Traders is not the company. GTC Traders is the brand, okay? The company owns the GTC Traders brand. You with me? Okay, because this becomes important. GTC Traders is owned by its company as a brand. And that company has various partners, and that company is also itself within a larger corporate structure, which, let me tell you, made tax time very fun this year. And yes, I'm being very facetious and very sarcastic. Regardless. So it is it's a brand owned by a company, and the company has partners, and that company is within a larger corporate structure. Okay, great, wonderful, Dan. I think you've sort of mentioned some of that before. Okay. However, I've also mentioned that I'm involved in institutional efforts, and I've been somewhat vague on that topic. Why? Why have I been vague about that topic? This is something we went over with GTC premium members recently, and I want to go over it here because it's a reasonable question. Whoa, wait a minute. If you're in an institutional firm, shouldn't you just be screaming that from the rooftops? Well, let me sort of let you in on the way the industry works. And the way I will do that is I will point to other folks who are professionals with a resume in the industry, right? I always point to Conks, Conks on Twitter, because I love his material. That man has literally forgotten more about cash models than I've probably ever learned in my 30 years. Literally, he'll release one of his Conks sort of releases on the inner workings of various cash markets. And I and another partner and a friend of mine, who, by the way, is the greatest short-term trader I've ever met in my life, better than me, we will sit. So the reason I say that is we are no slouches. Okay, we're not amateurs or something. We're pretty well established with pretty outstanding track records. But we will look at Conk's stuff. And this is not, I don't know Conk's, never interacted with him other than maybe a couple of replies in a tweet or something. Have no idea who he is. So this is not to, pardon the expression, but this is not to hump his leg or nothing. I'm just saying, we will sit there and look at each other. It's like, I've had to go over this 3 or 4 times just to get the concepts in my head of what he's talking about. I mean, it's just phenomenal stuff. He's also released a few images, Conks has, of the institution he worked at. And I'm not going to go into any detail there because it's not my stream and it's not my business, right? But he's done that. Who's Conks? Gee, you sort of wonder why he's anonymous, huh? Have you ever wondered why, as a person gains more depth in the institutional field and is working in that field, they become a little more anonymous? And you could say, no, Dan, that's not true. That is not true. I know these other guys, and they have their full name out there. Interesting. Let's examine that. And I'm telling you, we're going to get into some regulations and the way the real world works here and why people do things the way they do them. Okay? I know of several individuals who have presence on Twitter or in different social media venues, and they've got their real name out there, and it's an impressive resume. I know a couple of them worked at Solomon, some worked at Citadel. I know a couple worked at Bridgewater. Did you notice the tense of the words that I used there? Worked. Past tense. They no longer work there. Are we starting to see something? Generally, when somebody is in an institution and is currently working at an institution, they generally want to stay anonymous. And I'm going to get into the regulations of why that's the case. And generally, when somebody leaves a hedge fund or leaves a particular institution, then all of a sudden you know their name. Oh, quite interesting, isn't that? So let's talk about that for just a little bit. And this is going to get into why I'm intentionally vague about institutional efforts. I will never mention the name of the firm that I am a principal in. Okay? Why? Why wouldn't you just be shouting that from the house? Especially if the track record is outstanding. Like, you would think if the track record is outstanding, why wouldn't you just be screaming that from the rooftops? Guess what? I'm the principal in that firm. Look at the track record. Holy smokes. How do those guys, right? But why don't I? And why won't I? Okay, let's talk about that. When you work at an institution, or you're a principal like I am at an institution, there are rules that go along with that you have to pass various tests of the government, and you have to get to know the rules. And one of those rules is that, and again, I'm trying to explain because people have brought this out in social media, like if that person's at that institution, why wouldn't they talk about that? It would be very natural for them to establish their credentials by saying that. Okay, well, I can think of the very first rule that comes to mind that basically states that if you mention the name of your firm, okay, so if you mention the name of your firm, it could be considered as a promotion and an advertisement for that firm. Okay, so what's wrong with that? Well, if you're going to promote your firm through any sort of social media, newspaper, radio, does not matter. The regulatory agencies mandate that it's a promotional material and it has to be submitted to them for review a certain number of days before the public gets a hold of it. Sometimes it's around 10 days. It can be a little bit more. But basically, the regulatory institutions are like, listen, we understand people can get out there more easy than it's ever been before at any point in history and start saying stuff. And if you're going to get out there in the public sphere and start saying stuff, and you're a registered individual at an institution, and you name the institution, and then you start saying A, B, C about, trades or anything else, well, wait a minute, you're promoting your firm. Let's say, because of it's all 50-50 and it's all random outcome as far as future events, or perhaps you have some discretionary skill, whatever you said in the social media sphere actually occurs. Well, then any regulatory agents could see there, you named your firm, then you said this, then that happened because let's say you do have skill, you're promoting your firm. You're promoting your firm. So if you're going to do that, we need to see the materials before you release them to the public, which, quite frankly, I think is very fair and reasonable. We don't need you developing this following out there and then all of a sudden, you're promoting yourself and we've never heard a thing about it. Like, we want to make sure you're following the rules. You're very clear. You're not misleading. It's not that you can't talk. We just want to know, right? We want to make sure that you're being fair. You're being very balanced in the way you promote your information. And you would think, okay, well, this all sounds well and good. And Dan, I remember you back from the old days, and that's always been your approach. So what's the harm? What's the foul? It slows things down incredibly. You have to, first of all, record whatever you're going to record. Then you have to ship it off. Then they have to listen to it. Then they have to review it. Then that could take up to 10 days. It could take longer. And then they can say, we loved everything about it. We think what you're releasing and putting out there is perfect. We just don't like how you said this one thing. And then you go back and listen to the one thing you said, and it was like, oh, crap. If I take out that one thing, it was tied to the greater overall outline that I was trying to build. So now I got to restate the whole thing. So then you re-record. Do you understand how this can become very, very cumbersome? So the very, very quick way around that? You just don't mention the firm. You don't mention your name. You don't mention the firm. You don't mention where you're the principal of, anything like that. You just don't put it out there. Because then you don't have to deal with the regulators, which are doing a good job, quite frankly. And I believe in a lot of what they're doing. Because people shouldn't be getting... the number of people... I developed my reputation on social media. What was that? From 2008 to 2017. All on the basis of listen to this Jack Muppet and how wrong he is factually and objectively. And he's using that to rip people off to the tune of 6% maintenance fees. Can you even believe this? Right? And so I, of all people, agree with the whole spirit behind making people accountable and presenting things in a fair and balanced way, being clear and not misleading. Our tagline for many years during that iteration on social media was what? Reason, rationality, balance. Don't use emotion to sway crowds and people. Use logic. What's objectively real? What is actually happening aside from the emotion behind the whole thing, right? So I believe in many of those regulations. The problem is it slows the whole process down. It just takes so much time. And if you want to put out regular content, there's just no way to do it. So you know what a lot of people do? They just stay anonymous. They don't mention their firm. They don't mention their name. They don't promote the firm. And they know like myself, they present everything in a fair and balanced manner anyway. They have a risk disclosure statement of some sort, like we did at the beginning of this podcast, and they stay anonymous. Right? Well, Dan, what about those people where you do know their names? Well, generally they own their own firm. They have a Series 7, and I'll just be brutally honest, some of what they put out there, I don't know how they're putting out there without regulatory review. I don't know how I don't want to say getting away with stuff, but You know what I mean? Let me tell you something. I have a friend, very close friend, and he's a business partner. And me and him often comment on the fact that I couldn't land a number if my life depended on it. And he's much the same way. We have sat and had 2-hour conversations where we're near tears laughing with each other, just as friends do. Because it's like, dude, can you believe my timing and my luck? Right? It's like that Seinfeld episode where it's like, where Jerry looks at George and says, "You will not believe what an idiot I am." He says something about Elaine giving him an out, and I didn't take it. He's like, "I am an idiot." And George looks back at him and says, "Oh, is that right? I just gave up guilt-free, with this woman for a lifetime and basically lifetime tickets to every sporting event at Madison Square Gardens. So please, a little respect, for I am Costanza, Lord of the Idiots." Right? Great scene out of Seinfeld, greatest comedy that's ever been, sitcom comedy that's ever been on television. Regardless, we'll sit and tell stories back and forth to each other. It's like, no, dude, you don't understand how bad my luck and timing is. It's like I couldn't pull a number to save my life. I launched a new prop outfit, and when did it launch? What month did I pick for this whole brand new venture? March of 2020. That's when the whole thing went live. I tell you what, you want to talk about some robustness testing? Hoo-wee. That was some robustness testing. Right? So it's like that sort of thing. It's like, give me pocket rockets. I don't know how I'm going to screw up this hand on poker, but somehow I'm going to get pocket rockets, and it's going to be 22777, or you know what I mean? Or 2277, like 3. On the flop, the river, and the turn. It's unbelievable. It's absolutely unbelievable. And somebody else is going to have the quads. Don't ask me. It's like I couldn't land a number to save my life. Well, why am I telling this joke, and why am I being humorous about that? I say that to say I don't know how all of those guys out there with their name, but, they've passed some of the regulatory constraints that I have not passed, some of the tests that I haven't passed yet, which gives you a little more freedom. But others I look at and it's like, I have no idea how you're getting away with that. But they do, and they seem to get away with it year after year after year after year. And they just get away with saying whatever they want to say and promoting their firm, and it's not fair, it's unbalanced, they're promising results, they're promising returns, they're doing all sorts of stupid things, and they don't seem to get busted for it. I could name my firm in a podcast, I swear to God, and I would be up for instant review. It's just my luck. You know what I mean? It's like I'm the guy that's going to get busted when I didn't even do something wrong. It's just like, well, you named your firm and that could be considered promotional. So, can we talk with you for it? It's like, oh my God. And then I got to go through that headache. So it's like, how you avoid all of it? You just don't mention the firm. Like if the information's valuable, why would you need to? Why do you need to mention your firm? If the information has a value add to the people you're putting out there, then what does the name do? I mean, again, case example. Let's go back to what we were talking about before. Conks. I will sit there with other guys and be like, oh my God, Conks, did you just see what Conks just dropped? No, I didn't see. Are we sitting there obsessing over, yeah, but who is he? And what firm does he work for? And where is he currently at? And no, because the value add of the information that he's providing. That's all that really matters in the end. So what more is the name going to really factually do? I mean, why put the name out there? Why? And I'll tell you why people do it. The ego boost. I don't have an ego that needs to be fulfilled. You know what fulfills my ego? Money. That's what satisfies me. Money. So if I'm getting the money, I don't have some ego that needs inflated even more than the money that I'm receiving. So, okay, whatever. I just don't need that validation or whatever from others in the public sphere. Plus, there's no upside to it. There's only regulatory headaches. And then there is always the crowd that wants to dox and wants to, oh yeah, but what about this month? And then I've seen people, I swear to God, look at some of the most successful hedge funds on this planet and rip them a new one because they had a bad quarter. And I'm sitting there thinking, their track record still is absolutely outstanding long term. And you couldn't be proving yourself to be more of a jackass by pointing to a quarterly drawdown that everyone has and making that out like, boy, they just don't know what they're talking about. Because they had some statistically normal, well within program variances drawdown, and they want to rip them a new one. And everybody else that's just, I'm sorry, but completely idiotic on their education when it comes to finance, investments, and returns and the way it actually works. Oh, yeah, boy, he's a dummy. And then, my question is, where's the upside? People say that about Buffett. They've said it about Dalio. They've said it about literally everybody. I bet you there's guys out there about Renaissance that have said it. I've heard people say, try to rip Millennium a new one when it comes to Millennium's performance. Seriously? So, if you have that jackass crowd out there, I ask, what's the upside? What's the upside? I don't see one. I'm a trader. I think in terms of risk. I think in terms of reward. And all I see is downsides. That does paint a pretty bleak picture. Right? What are you doing this for, Dan? I enjoy the teaching aspect of sharing through this sort of venue. There's just a bent I have that's just a teacher, and I love to teach. Yeah. Actually, another business partner said that about me. He says, yeah, you definitely have that teacher bent. Well, it's not something I was naturally born with. I was actually sort of gifted this. I have probably, good Lord, you start to, as the years pass, forget what year it is, and you forget how old you are. But goodness, I probably have maybe 40 years worth of formal instruction on public speaking and teaching, logical development of a theme, use of an outline, pitch, pace, power, how to change the cadence of your voice. I actually think I probably need to bring those skills more to bear in podcasting than I actually do. Get a little more formalized with things like an outline, but sometimes we get a little lazy. But regardless, I love to teach. So, let's circle back more to what we were talking about there at the beginning. We were talking about GTC Traders as a brand that is owned by a company. What does all of this have to do with, the fact that, public posts have been rather sporadic? Well, let's talk about that for a second. First of all, there have been posts almost every single day, a couple of them, for the premium members of GTC Traders. Okay? So we have a daily note that it's not really about specific trades, really. Well, let me put it this way. There are 2 posts every day. One doesn't have to do with specific trades, and one does have to do with very specific trades. So usually, minimum, there have been 2 posts per day. The first one, again, doesn't really have as much to do with specific movements as far as specific accounts and everything. The second post definitely is nothing, it's all about that. It's all about, okay, looking at it at the end of the day, looking at this account, this account, this account, very, very specific actionable events for those programs as a look over our shoulder. But going back just a second to that very first post and just talking about the very first post, we refer to that as our just daily note, or in the beginning of the week, the weekly note, but just the daily or the weekly note. It's not about like we're doing this or we're making this move. Most professional firms on the planet have like a daily note or a weekly note that they do, and we're no different at my private proprietary firm, and therefore we have a daily note, right? And so we thought, just to let ones know, this is sort of modus operandi of just putting your thoughts in a structure written down in a note. Here's what we think as a firm is important. And so we just copy and paste it over. It's like, ooh, is that the secret moves you guys? No, it's not moves. It's what we think about each market, bearish, bullish, neutral, what our overall outlook is, what we think is going on a global macroeconomic basis once a week. That's it, right? And then at the end of the day or during the middle of the day, we'll talk about moves that are being made onto a GTC sample portfolio comprised of 3 different programs. An equity fixed income hybrid sort of core program or account that we are running. Then there is a long-short valuation investing component that we're running. And then there's a short-term trading aspect, short-term trading account that we're running. So 3 of those sort of make up the multi-strat of the GTC sample portfolio. And we talk about the very specific moves we would be making on those 3 programs. Okay, so very specific, this percentage of the account making X move or buying XYZ or exiting this position or that's a loss or get out of it, right? I think once a month we post the ledger to show basically all the dividends, everything, every trade, and we post that, right? So there are exact moves. So we say all of the preceding to say that basically, yeah, there's been at least a couple of posts every single day. And then we have some supplementary posts. We even had a podcast recently for premium members, right? So I would say we haven't abandoned the brand or anything. Actually, we have that going on every day. I would like it to be more, actually. So this circles back to what we were just saying a few seconds ago and how it all ties together. GTC Traders is a brand that is owned by a company that's in a larger corporate structure. On the institutional efforts, that was in a stage of the game where there was a lot of heavy lifting as far as work effort in the beginning. And my time just got very, very, very pressed, I would say, with that heavy lifting. That heavy lifting is now coming to an end, right? And I wanted to get GTC Traders started and up and running as we have done, because now the infrastructure is in place to fill it out, right? And I enjoy that filling out process and the making of the video entries and the playlists and all of that. So that's all coming. And now that the heavy lifting's done, then we can sort of more focus more on podcasts and doing things like this. And I have my time more freed up, which has always been the goal. But since GTC Traders was a brand, my focus had to be on the institutional efforts. You sort of see how it's a passion project. And for premium members, we are putting stuff out there every day. And we are showing the exact moves on the GTC sample portfolio. I'm really happy with the long-short valuation investing because we have only been looking at shorts for the last 2 years. Literally, last 2 years, only short on that program, and it's up. And that's just our specific mandate, and we've told premium members why that is. We've broken it down pretty pretty substantially our thought process there and why we're only interested in shorts against this market. And I think we've had one down month in the last 15 months. We are only interested in taking shorts. We've got a very specific program that we're running there at 100%. So we haven't abandoned GTC Traders. For the premium members, there's been something every day, and I think it's a pretty big value add. Sorry, but, however many thousands of dollars returned on what was a very small account. And, the long short is only interested in shorts for the last 2 years and has only had one down month, I think. Maybe 2 down month. But regardless, if you've been trying to short this market, we think that's pretty good. Beating the risk-free rate. And up overall, we're actually up this year. I don't think, maybe in April we might be down a few basis points. But we're basically up for the whole year, so better than the Spoos is doing, right? So, we haven't abandoned it, but on the public side, since it is just a brand within the ecosphere, you know what I mean? The ecosphere has to take precedence, and the institutional efforts have to take precedence. It just has to. A lot of that heavy lifting is now coming to an end. Yeehaw. I want to work as little as possible for as much money as possible. So thank God it's all the heavy lifting work is sort of coming to an end. And the GTC premium members have been getting entries at least a couple times a day, sometimes 3 or 4 times a day. There's a lot more there I want to go over. I want to go over spreadsheets and formulas and all that stuff we used to go over. And get into a little more detail, even than I have been, because we've been putting out sometimes, like I said, 3 or 4 entries a day. The daily note is sort of a must-have, and then a portfolio review. But we've been putting out other entries. But on the public side, we need to fill that out, and hopefully the state of things is such now that we can start to do that now that all the heavy lifting's over. Does that all make sense? Hope that makes sense. Brief version is that we haven't gone anywhere, and there's been posts every single day, sometimes generally 2, sometimes 3, sometimes 4. There was even a podcast recently for premium members. On the public side, it's been light, but that's because we're focusing on institutional efforts, and we have the infrastructure set up now. But now that the time's freed up, we can start maybe having more public entries. Okay, so that's sort of the GTC Traders side of things. Let's switch gears now that you're sort of caught up, and hopefully we can have more of these in the future. Let's talk about markets. Because, oh my Lord, things have gone on. For like the last year, I've thought, man, I should do a public podcast on sort of what I'm thinking, because, man, I am nailing this. Like, we are just... John Moulton, Rambo, one time said, sometimes you get that moment where you feel you're like at the head of the comet and not the tail, and you ride that as long as possible. Well, I've felt like in the last year or so we are just on the head of the comet. So what does that mean? It means understanding your environment. I think when it comes to investing and when it comes to trading, it is critical to understand your environment. I think that's why you hear so many multi-strat guys like myself. When we say multi-strat, if you're new, that means multiple strategies running simultaneously for a benefit. I think that's why you hear us talk about global macroeconomics, and I think that's why new people get confused. They hear us talking about macroeconomic forces, and they think, okay, so they're putting on this trade because of their, or not putting on this trade because of their global macroeconomic thoughts. It's very, very nuanced. Not really. Sort of yes and sort of no. And we're in that part of the podcast where we're sort of sliding from the state of things for GTC traders and starting to talk a little bit more about the way things work. And we do want to get into more of a discussion about how I see things for the state of the economy. So we're sort of working a bridge here right at the moment between those two ideas and sort of in explaining some of our moves and some of our thoughts on macroeconomics, sort of explaining for everyone, really, the way things work at major firms. The way things work, for if you've got a firm that's a multi-strat firm and they start speaking on global macroeconomics, it can get confusing as to why they're making certain trades. I was talking with a friend about this recently. When you have various trading programs, right? And I don't care where you're at. I don't care if you're at Renaissance or where you're at, Citadel. You don't just have quants code up a program, right, and test out the thesis and then take it through robustness testing and check out its slippage and what sort of execution problems are there and take it through all of that testing and then just let it run and never think about it again. It's funny because we were having this conversation and he was talking about it. We both know it, but he was just, sometimes you just talk about things you already know. But no, you have to continually review. Markets are very, very complex. And when I say markets, I don't mean, the Apple market, I mean markets in totem, global markets. And they adjust and they adapt because they're made up of human beings making decisions. And there's external stimuli to the entire system. Unforeseen events, true black swans, Things get priced in. The market ignores some things. There's tail risk. There's fat tails. It's exceedingly complex. And over time, markets will adapt and change in very subtle ways that if you don't keep an eye on your program may start trading what we would say outside of variance, or basically trading in a way that's like, why is it performing like this? To the upside or to the downside, that's just not normal, right? So you still keep your quants, your quantitative teams in place because they need constant adaptation and review. Make sense? Hope that makes sense. We had just mentioned that at times markets will change in very subtle ways. We have shared with premium members one of the things that we've noticed about volatility specifically. Volatility compression, I would say, has changed substantially within the last 10 years. And so if you had a program that you designed 15 years ago or something, what has that volatility compression done? Because you tested what we say with in-sample data, right? Let's say 2015 and everything before it, and you back-tested it, or you had tested the program for 20 years, and then you put it through robustness testing and everything like that. And then we've gotten this volatility compression. Now, if you have a trading program and it's continued to work and operate within variances, you can sit there and smile and say, okay, you know what? This thing has been pretty robust. And if, it's just considered a very, very tough trading program, it's been well designed to withstand what we call out-of-sample data. What is out-of-sample data? The future, right? So we say all of the preceding to say this is why multi-strat guys talk about macroeconomics. That's what we're interested in, how the markets are processing new stimuli that it's receiving from the economy, because it could change our programs. Now, I poked fun on the Twitter stream a little while ago, and we've also been very, very active on Twitter as well. So it's not like we've just been away for the last year. We just haven't been doing podcasts and videos and things we hope to be getting back to. But regardless, on Twitter some time ago, I had made the comment, that I was sort of poking fun at multi-strat guys because I like to study. I'm no graduate level, economist or anything, but I do like to read people I like to read those who are graduate level economists, theories, nonlinear models for modeling economics. How many variables are you tracking on your end plane? And, what state would you consider, the current model in? Is it in shock? Is it post-shock? Is it in equilibrium? That sort of thing, right? And I was sort of poking fun. I say that to say I was sort of poking fun at some multi-strat guys because it's like, let's face it, guys, we're just casino operators running our trading programs, and it gives us the aristocratic time to wax philosophic on the economy. I think there's a little truth to that. There's a little truth to it. I mean, sometimes you back up and you say, I'm concerned about all of this minutia in the economy, and quite frankly, my multi-strat's doing its thing, right? So I think there's a little truth to the fact that we all do it, and I include myself in that number, that we like to wax philosophic about the economy when really we're nothing more than glorified casino. Obviously there's a real economic benefit to investing and trading. I'm not saying there's not, but what I'm saying is, it just reminded me of that line from Margin Call where Will Emerson's talking about the general public's hypocrisy in that they want Wall Street to give them all of the benefits and all of the bonuses that come from having a Wall Street, except for that idiotic crowd that are just jackmuppets who don't understand how economies work and how absolutely vital it is to have a financial sector, right? And to have people paid very, very well to do it. But he was talking about that hypocrisy, and it was one of my favorite scenes. And he's like, he's talking about people in that aspect. He says, people want to live like this in their cars, in their big houses they can't even pay for. Then the financial sector is necessary. The only reason that they all get to continue living like kings is because we got our fingers on the scales in their favor. We take our hand off, and then the whole world gets really fair really quickly, and nobody actually wants that. They say they do, but they don't. They want what we have to give them, but they also want to, play innocent and pretend that they have no idea where it came from. Well, that's more hypocrisy than I'm willing to swallow, so forget them, right? I'm paraphrasing a little bit for language and whatnot, but I sort of made that joke and sort of paraphrased Will Emerson's line when it came to multi-strat guys. It's like, we all want to live like kings and pontificate on macroeconomics when we're in actuality running just multi-strats, but we want to pretend like we are running some highly developed adaptive Lotka-Volterra model that's been adapted to macroeconomics with, an incredible number of variables on the end space, when point in fact we're just running multi-strats that are pretty robust. Well, that's more hypocrisy than I'm willing to swallow, so screw them, right? And I made that joke sort of comparing the two. And there is some truth to it, but I will say that at the same time, it is important to sort of look at the dichotomy, right? Every idea is very nuanced, and there's a dichotomy to most things. There's a flip side. So when we study the dichotomy, actually it is somewhat important to understand macroeconomics because we are very interested on when the market changes and when it changes, if our models have been robust enough to keep up with those changes, to not have to be, not tweaked is the wrong word, but do you have to go through the entire model again and rework the entire thing with the new in-sample data because is there some way that the market's changed? That's not maybe ruined the model, but it's definitely askew, right? And is there something that can be done for that to save the model, right? So we do have to be interested in macroeconomics and how things impact us because, as I often cite the Lucas critique, when it comes to macroeconomics, things are not going to play out the same way they did in the past. If you look at what seems to be through human apophenia of wanting to try to fit a pattern of a past occurrence. It's like, well, there were tariffs back here and there was inflation back here, so let's just fit that to the current environment, and therefore that means X, Y, Z. As Robert Lucas won his Nobel Prize for, that thought process is exceedingly naive because no two events are the same. They're just not the same, and they're going to work out differently. There can be similarities, and there can be lessons that you learn, and there can be dangers that you have to be aware of. But it's exceedingly naive to think out it's going to work out in exactly the same way, because it won't. The Robert Lucas critique. So yeah, we poke fun a little bit at ourselves as we're just running multi-strats. We're not actual economists, but in a way we're more economists than some economists because we've got money on the line. I mean, honestly, that's what it comes down to. We've got money on the line, and having money on the line is the real measure of anything. Anybody can get out there and just wax philosophic about anything, right? So just to review what we've said to this point, the reason why it's important to sort of take a look at sort of a global macro view, even though, a bit of self-depreciating fun to keep things lighthearted, to keep us humble. We sort of have a little bit of, self-depreciating humor about it. It is important to sort of take a look at initial conditions. And when we say that, we mean right now, what's going on right now, which is exceptionally difficult when it comes to global macroeconomics because we have money on the line. And as markets are exceptionally complex, we want to know what's going on because things change over time. And if our models have some sort of adaptive switch in them, we may need to rethink that switch on how it adapts to new market regimes. Okay? So that's why it's important. It's not to be completely accurate. We're not just waxing philosophic about what we think. We take a look at what we see, and we try to keep an eye on as much as we can without just burning ourselves out, because Lord knows that's a possibility. Look at enough to what's going on and say, hey, is it impacting my models because I have money on the line? And is what's changing in the market, is it changing enough to where I may need to rethink something somewhere? So, not because we're making some discretionary trade, yay, inflation, buy this, buy that. No, it's much, much more nuanced than that. So, now we are finally to that part of the podcast. So if we're going to talk about the state of things for what we see. And we have not had a podcast in a while, so I'm going to have a little bit of review here, okay? Because I will say we do keep track of sort of our macroeconomic look on the GTC sample portfolio page, okay? So we sort of keep track. Because have you ever heard that where ones are like, this guy's up on television or CNBC or wherever he's at, waxing philosophic with his pontifications? What's his track record of economics actually look like? There's a couple of yahoos out there I think need a lot of scrutiny under that particular, if we're going to talk about things from that particular lens. I think they need a lot of scrutiny. And so we thought, well, to be fair, let's put up our track record of sort of our take of macroeconomics and just what's going on a macro basis. And fine, we'll put ours up there. We have been, and I'm just going to say this, blindingly accurate for a long, long time. This is not to toot my own horn, but I've got a track record, and it looks really stinking good. Now, does that mean I'm not going to have a misstep somewhere? No, that doesn't mean that at all. Matter of fact, my current read on things right now could be, a giant misstep. That is the nature of markets. You eat what you kill. And if you're not a good hunter or you make a misstep, it doesn't matter how skilled you are, guess what? You don't get to eat. So even though my track record has been fantastic to date, that's what you did yesterday. What have you done for us today? right? And all we can do is what we can do. So, but the track record does look really good. And on that GTC sample portfolio page, when you scroll all the way down to the bottom, and we keep track of those sort of macro views, we didn't even include some of the other stuff that many of you who were with me in the first iteration know about. 2008, wildly bearish during 2008, which was unusual for me at the time. It really, really was, because we were coming off of the 2000 to 2003, bear market. And usually, given those sorts of circumstances, I would not, with my models and the way I view markets, I would not be as bearish as I normally was during that time. But I had a lot of friends that worked at a lot of banks and prop outfits at the time at the banks, and I got incredibly bearish. So, yeah, we didn't even include all of that, right? And we didn't include me getting bullish during 2009 and then staying bullish right up until I left my public presence. And sort of poo-pooing on every inflationista that I could come across. So we didn't even include that. But let's do a little bit of catch-up with some of our recent views. I'm going to have a brief summation, sort of that line, right? Again, from The Princess Bride. Let me explain. Now, that's too much. Let me sum up. So let's have a little bit of a summary, and then we'll get to we'll sort of let that evolve into my current thoughts on markets. In 2021, after, as I said, sort of poo-pooing every inflationista I could come across, I switched. And some people that had known me for decades were sort of surprised by that. They're like, "You're not the inflation guy." And it's like, no, that's not accurate. That's not fair to say that of me. What's fair to say is I'm the objective data guy, right? I need to know objectively what's going on so I can make the proper decisions. I'm not in a camp. I have fiduciary responsibilities that I take very, very seriously, so I'm not in a tribe. I'm actually in the tribe of I want to make money, and I don't want to screw up. So wasn't in the anti-inflation crowd, right? And some people were a little bit surprised in 2021 when basically anybody that would listen, I said, listen, this inflation's probably going to be the worst inflation anybody alive has seen. And I was saying that in like July of 2021. Listen, inflation always has been and always will be too little money chasing too few goods. Or too much money, excuse me. Let me back that up. Screwed that up. I had this quippy little saying, and I screwed it up. It's always too much money. Too much money chasing too few goods. And that's what we had in 2021. Everybody was handed way too much money for resolving the supply, and the supply chains got fouled up. So what's going to happen? There's only one thing that can happen. And on top of that problem of the supply chains getting messed up, and then everybody being handed a ton of money, so what do we have there? We have too much money, too few goods. We had the Federal Reserve pouring gasoline on that fire. And when they ran out of gasoline, they went and grabbed another tank and then poured more gasoline on the fire. Much of what happened can be attributed at the Federal Reserve's feet. Now, as we progress, I'm going to be talking about some policies. And I want to have this disclaimer in here. And I just said it. And I'm going to say it again. Because it's funny. You say certain things and people don't hear the disclaimer. They only hear you as in a tribe. Because human beings are very tribal and they want to assign you in a tribe. I'm not in any tribe other than the I want to make money tribe. If you can listen to anything I say and say, oh, Dan's of this political party or Dan's of this economist, then you, brother, you got me pegged all wrong. Just like people who thought, I thought you would have been in the transitory inflation crowd. I'm surprised to hear you say that inflation's not transitory. Brother, that's because you got me all wrong. I just want to know the data, and I just want to understand initial conditions as much as humanly possible. And the initial conditions at the time, it wasn't a prediction about inflation. It was already starting to occur. See, sometimes when I've had these podcasts in the past, people are like, man, Dan predicted this like crazy. It's like his calls are so accurate. I don't believe in calls, and I don't believe in predictions. It's understanding the initial conditions without a political bias or some sort of economic bias. It's just understanding the initial conditions. I think the movie Margin Call did an excellent job of this in illustrating that concept. You know, the difference between The Big Short and Margin Call, a friend and I were talking about that recently. When you're a financial trader and a principal at firms, right? When you talk with your friends, what do you talk about? You talk about work and you talk about markets. And The Big Short, it had some flaws. But one of the good things about The Big Short is it showed the crisis from the perspective of adversarial hedge funds in the New York City ecosphere, right? It's very, very adversarial. And I think it did a really, really good job of showing that. Margin Call showed it from the perspective of inside one firm and at the executive level. And I think they did a phenomenal job of showing that. But in the very beginning of the film, right, they discover the assumption on a Gaussian copula linear distribution model, and they really, I think they do a really good job of illustrating we made an assumption as to the time aspect. They didn't get as much into the fact that with that equation they were using to model risk, you can't, when you have different tranches like that and you have different aspects that you're modeling, you can't have you can't just model the risk down to one nice, neat little number, because during all risk events, all distributions are nonlinear in nature. They are not linear. And they were using a model that tried to look at risk on this one asset class and boil it down to a single number. They didn't do as good a job of that. But what they did show is a really good job is showing we made an assumption. And now when we look at the initial conditions, and this backs up to what I was saying a few minutes ago, when we look at the initial conditions of right now today, we're screwed. And you sort of have to understand some financial jargon, and you do have to sort of understand some of the terminology and the subtleties of what was being said. But basically, they all sat around that table and said, you know what? Guess what? We're all insolvent. This whole institution, it's insolvent. Great, wonderful. As of today, right? So was that a prediction of the housing crisis and what followed? No. And that's where I think Margin Call did a really good job of illustrating what I'm trying to talk about here. Understanding initial conditions is important, right? So when we back up and we go back to 2021 and Dan's saying, no, this is not transitory inflation. No, it's not going to calm down. We have a serious problem. The Federal Reserve at this point, and again, I am not making a political or any sort of policy statement. I have to make decisions. Listen, you have to understand this. When I speak of anything, and I'm going to talk about some other communications, when I bring that up, it's not to make a political point. It's not to say I'm on this side. If you can listen to anything I say and say Dan's on that side, then I've done a very, very poor job. I just want to know what's going on. So I'm going to mention some things that are in the news as of late. I'm going to mention the Federal Reserve. I'm just trying to make a critical assessment of what's going on. And the institution I'm dealing with such that I can make fiduciary decisions. Okay? So I view the Central Bank of the United States and the Federal Reserve as in a very, very, very bad spot. And it has been for some time. I, along with many other institutional guys, have looked at the Federal Reserve for the last 5 years and just scratched our heads like, what in the name of all that is holy are they thinking? And to somewhat prove the point that this is not a political statement of any kind, I have talked with guys that are, I guess, in other firms that you would consider on the right. I have talked with guys in the middle. I have talked with guys that consider themselves on the left. I talk with many different principals, and all of us, almost to a man, was like, I have no idea what they're thinking. Like, this is insane. So during 2021, when we had supply chain interruptions, Economics 101, I'm not talking about a Volterra model that's been adapted for economic nonlinear, I'm not talking about some wild economic theory. When you have too much money, you have supply chain interruptions and too few goods, that's inflation. And during the middle of it, they lower the rate down to ZIRP, showing a predisposition that has been built into the Fed over many, many years. And quite frankly, the Federal Reserve had a critique aimed at it from like 2012, which is, I thought Chairman Bernanke was brilliant. I think he stayed too long and became a victim of his own tools. Because then back in 2012, people are like, this can become a moral hazard. In 2015, this can become a moral hazard. In 2016, this can become a moral hazard. We're not seeing inflation yet, but, well, what's the moral hazard? Inflation? No, the moral hazard is thinking your solution is always diving to zero immediately. And guess what? We are now, I believe, living the moral hazard. I really think we are. It has come home to roost. You can only kick the can down the road so far, and they were warned of that from 2012 to actually since 2009. But 2009 was a rescue operation, so the whole thing didn't fold up. But 2011, 2012, 2015, 2016, 2017, well, so many forces, and I'm going to get into my current view of things at the moment. So many forces are coming to a head right now. But they, as I was saying a few moments ago, when we have all these inflationary forces, they dive to zero and they stayed there. They stayed there. And I'm seeing data come across my desk that maybe I'm not an expert in that field, but I'm reading published papers by those who are. And I'm reading a lot of data. And I'm thinking, why are they keeping the rate near zero? Like, this is going to get bad. And it did. The inflation blew up. Absolutely blew up. Worse than most alive, not everyone, but most alive had ever seen. And this is important to understand, because it's going to tie into something that's happened right now. They were behind the power curve. They were playing a game of catch-up. I said that first rate hike, take a play out of Volcker's book. Come across and over the table and smash the markets in the face. Do not do this in a, let's walk up the rate to try to get a hold on and see where we're at. No. Come over the table and smash them in the face. Raise it 150 basis points. Oh, I don't know, Dan. Dan's talking a little crazy. Was I? Because now we look back at it and it's like, yeah, they were sort of behind the power curve. And I got to tell you, with the statements I've heard lately, I cannot fathom or stomach the concept that the Federal Reserve is going to sit there and tell me, as a guy that has to make decisions on the policies that they're making, that they are data dependent. No, you're not. And I'll get to that here in a bit. But so many of the problems can be laid at the Fed's feet, right? So inflation expands. Finally, we find a spot where inflation starts coming down. We find that area. And I said during the time, they've got, if inflation's going to keep coming down, they have to keep their foot on the pedal. They either raise maybe, and they don't even have to. See, here's the thing. The Fed has so many tools in their toolbox. They could use language guidance to infer that they're going to raise maybe another 25 basis points sometime later this year. And keep on, that could be keeping the foot on the rate pedal. They don't even have to increase to 25 basis points. Keep that tone of language, and they didn't. Or raise it 25 basis points once in a year, or just keep it flat. Keep it flat. Whatever you do, don't take your foot off the pedal. And GTC Traders, my private proprietary firm, my business partner, my other institutional firms, we were all telling each other that. Whatever you do, for the sake of God, don't take your foot off the pedal. What did they do? Once inflation had come down, they took their foot off the pedal. And they started not only cutting, in some cases I would say aggressively cutting, and then they began cutting and using language guidance in the future to say, and this is going to tie back to something I was saying a few seconds ago, we're data dependent, and our plan is maybe we could have this many cuts later on this year. And this is the point of the story where I and other professionals were absolutely scratching our heads in absolute disbelief. And a lot of guys started talking and comparing the current Federal Reserve to the era of Arthur Burns. Now, for those of you who are not up on your Fed history, and I'm not as much of a Fed historian and Fed watcher as some guys are, but he is generally considered the worst Federal Reserve chairman of all time. That's saying something. There's been some bad ones. Arthur Burns is considered one of the worst. And some others, and it's like, I don't like to jump too quickly to a position, right? But there's all this language guidance of cutting the rate. Now, for those of you who aren't familiar, and you may be new, and you may be tuning into this podcast the first time, when inflation gets out of control, basically the tool is you raise the interest rate, right, to sort of cool down economic activity. If you want some more inflation, because inflation's off on the floor and it's not going anywhere, right? If there's no economic activity, you sort of lower the rate. If inflation's out of control, right, then you raise the rate. It's a lot more nuanced and complex than that. There's a lot having to do with supply chains and how free and loose they are, and there's a lot more to it. But that's just so you know why we are confused. We're confused because we're getting fantastic GDP reports. We are getting good job numbers. Never went above 5% as far as I know. I mean, and I'm talking U3. Hold on a second. I'll look it up here on one of my other monitors. Oh, here we are. Yeah, never even got above 4.5% on U3. So, okay, no problems on labor. Inflation has come down, but still way too elevated. Way too elevated. And because it had come down, they celebrated way too early. Now, I said at the time, continuing this story, in 2024, I said, listen, I believe in the Lucas critique. We've already discussed the Lucas critique. The Lucas critique says it's naive to look at past examples and say that things will play out in exactly the same way for exactly the same reasons because no two situations are identical. He won a Nobel Prize for this. I often cite the Lucas critique. I believe it. However, there are broad situations you don't want to get yourself into, and those you can paint. You can look back to history. That's why we study history. We study history so we can see patterns and say, hey, that broad situation, that's a really bad spot to be in. You don't want to be there. I'm not saying it's going to play out exactly the same way, but that's a bad spot to be in. And so in 2024, we were saying, listen, they are risking another 1977, okay? Now you know why I gave you that disclaimer. I'm not saying, I cite the Lucas critique. I'm not saying it's going to play out for the exact same reasons. That would be exceptionally naive. But looking at the broad strokes, tactically, and for those of you who don't know, let me explain 1977 a little bit as we continue this story of sort of our current take by giving you a summation of what's led up to this point. In the 1970s, when I'm just a wee baby, and we're going back to the early 70s, everybody talks about the inflation of the 1970s without really understanding the story of exactly what happened. So when I'm a wee baby, right, inflation started to expand. And it went higher and higher and higher. And then the Fed tried to get a hold of it, and inflation started coming down. 1975, 1976, oh, awesome. You know what? Headway's being made. Inflation's coming back down. Great. It was still far too elevated, though. And the mistake the Fed made, going back to one of the worst Federal Reserves there were at the time, underneath Arthur Burns, and I have more to say on that topic, they got behind the power curve, such that when a crisis happened, whatever that crisis may be, they were playing this limp along game of catch-up. Not catch-up, not like Heinz ketchup, like catching up to inflation. And because of a geopolitical crisis, they were behind the power curve and playing catch-up. And inflation took off, and then it really got bad. I mean, really bad. Now, some people think that Paul Volcker came along and single-handedly, as the executive of the Federal Reserve, said, I lay my hand down and I decree higher rates, and that's what saved us. Volcker is properly credited for that, but it is important to understand the Federal Reserve. The Federal Reserve chairman does not have executive power the way most people think of executive power, right? That is why the Federal Reserve, when they're making statements, say, we are looking at the data. We believe this. You can't fire a Federal Reserve chairman and say, well, now things will be different because that bad guy is gone. No, that bad guy is not the one guy making the decisions. It's an entire governance system. The Federal Reserve basically is the federal front man. He's the front man of the band. You want to think about the Federal Reserve chairman? He's the front man of the band with no executive power to veto anything. He can guide. He has a tremendous amount of influence. He makes public statements. He can speak for the Fed, but he is just one vote of 12. So firing that guy does nothing. But Paul Volcker's genius was acquiescing and understanding the true situation, using his influence properly, and instituting what we now know as the Volcker shock, right? So, and he instituted the Volcker shock. We're not going to go through a whole history lesson here now of the Volcker shock and the famous plane ride and all of that. Suffice to say that Paul Volcker is properly credited with the Volcker shock and used his influence and understood its need and was able to communicate that very effectively to the public, to other politicians that were in charge of fiscal policy and coming into fiscal policy. Wildly effective communicator and front man, if we're going to use that term, for the Fed. Okay? So, rewinding what we were saying just a few minutes ago, we were absolutely baffled by the Fed because the inflation had come down somewhat. When you look at inflation metrics, you'll see this. We all sort of know this. And not only did they not keep their foot on the gas pedal, they didn't use language guidance in a hawkish tone, right? They didn't say, they could have just kept it flat, never raised the rate, developed a hawkish tone for language guidance, kept the markets somewhat subdued. But unfortunately, an infection over the last 20 years has infected policymakers that up equals good. Up equals good. So whatever we got to do for up equals good, never mind the global macroeconomic distortions that have crept everywhere into the economy. I believe Professor David Graeber had a lot of good things to write on macroeconomic distortions and how they can get cleared out. They get cleared out, as many people know, by healthy corrections. And the longer you avoid those corrections, the worse it becomes in time. But unfortunately, we have all been cursed with policymakers in many different venues. Fiscal, monetary, doesn't matter. That up equals good. Now it doesn't. And I'll illustrate that to you very briefly before we return to our point. You have a Rolex, right? Let's say you want to buy a Rolex. Actually, that's a better way to put it. And it's a beautiful Rolex Note 8 sub. Awesome. I want to buy this Rolex. All right, we're going to sell it to you for $3,000. Whoa, that's a good price. I'm all over that. Same person comes into the store, has not bought a Rolex Note 8 sub, goes to buy one. And the person looks at him and says, well, up equals good. So now that Rolex, is now going to cost you $10,000. It's not $3,000, but I can see it. And you come in 3, 4, 5 years later, up in prices always equals good. Now that Rolex sub, to run to the end of the illustration, is $750,000. I love Rolexes. Sorry. It's not worth that. The value has gotten too high. Always going up in a linear, straight up manner does not equal good. Okay? Regardless, whatever you got to do to make markets go up seems to be the thing. So it was like, nope. Despite the fact that inflation is still far too elevated, and they themselves were saying that, despite the fact that employment was fine, despite the fact that we're getting outstanding GDP numbers, despite the fact when you look at underlying economic metric data, everything looked good, we got to lower that rate. Despite the fact that the Fed themselves, the Federal Reserve Chairman, stood up in a press conference and they said, well, don't you fear that this is going to freeze up the housing market? He himself said, we think the housing market needs to cool down. So if asset prices come down in housing, good. That's healthy. Okay, wonderful, great. All right. Then turns around, despite all of this inflationary data, GDP is inflationary, jobs, there's no disinflation there. Housing's inflationary. Every econometric data you're looking at's inflationary. Has the audacity to say we are data dependent, so let's cut the interest rate 50 basis points. Because everybody's whining about it. That does not understand this. News anchors are acting like they know something, and they don't. Despite the fact that interest rates, historically, we weren't near high, we weren't even near the mid-range for what is historically normal in interest rates if you take out the last 10 years. We weren't even at the mid-range yet. Nope, got to cut the rate. They would come out and say things like, man, GDP's, we're really encouraged by what we see in GDP. We're encouraged we don't think there's a real problem in the labor market yet. Let's cut the rate 50 basis points. Like, what the heck? How do those two sentences even go together? And we said, at my private proprietary firm, I told institutional partners this. We put it in GTC Traders. You watch. CPI is going to turn around and start following core. Because this is nuts. Oh, wow, fancy that. Dan predicted that that inflation was going to go higher. No, I didn't. It may look like prediction. It was just understanding initial conditions. And sure enough, what happened? Now, around about this time, continuing the story, we're getting a new administration. And I have to say, I'm going to put this disclaimer in here again. I want to wrap this thing up, but I really do have to put this disclaimer here again because people have gone so tribal. They're nearly psychopathic. I have talked with people and said, listen, I have no bent one way or the other. I'm just looking at things. If you want to know what my take is on part of the data, and went off on me and assigned me a political motive, knowing that I don't. It's like I have fiduciary responsibilities. I'm just evaluating what I see. So I'm putting this disclaimer in there again. Don't assign me to a tribe. All right? I'm just talking about, from a neutral standpoint, reason, rationality, balance, what I see. So I'm seeing the new administration come in on the fiscal side of the house, executive, and I'm thinking, okay, I'm looking at the policies that they're talking about, and everybody's talking about how inflationary it's going to be, and it's like, I don't see these as inflationary as much, and I don't see anybody else talking that way. As far as asset prices and stocks, I actually see these as pretty disinflationary. I see it disinflationary for input costs. When we say input costs, if you're new, things like oil, what goes in to make stuff, right? The primary one, if you just want shorthand of what I'm talking about, things like oil, energy, materials. It's like I see a lot of disinflationary inputs. I'm still trying to understand their policy. To understand both policy and econometric data in any mature way takes like 3 months to even understand where you're at. It doesn't take one print. You don't look at the CPI and go, ha, see there, I was right. It's one print, right? It's a conglomeration of a lot of data. If we want to get nerdy, we could talk about polyharmonic data splines, which I've sort of fallen in love with. But let's not get nerdy. Let's not. Okay? What does that mean? What's Dan talking about? Look at a lot of data coming together and form a view over time. Okay? So I'm trying to get a handle, and it's like, you know what I see? Just talking initial conditions, and this is going back a few months in GTC Traders. For things like stocks, for energy, I actually see a lot of the policies as maybe there be some output gaps and disinflationary. I don't know. I got to get a handle on it. But what I do see is I see the inflationary forces that are just steaming right along, getting ready to hit what I would refer to as a new data spline. In other words, something new. Some people are calling that a regime change, right? With the new administration's policies. And I'm like, when I look at everything together, and the metaphor I came up with is, talk about an unstoppable force meeting an immovable object. I don't know how the intersectionality of all of this is going to come together, but it should be pretty spectacular. And thus we have had what we have had up to here in 2025. We arrive at today, okay? But I said that for a long time. It's like we've got a lot of these inflationary forces meeting disinflationary things. And what about now? What do I see right now? Okay, so that was all a catch-up. What do I see right now? I see a Federal Reserve that I believe is lost. As I was saying before, firing a particular individual is probably not going to encourage me as much as I think he may be one of the worst Federal Reserve chairmen. And I don't even think that's fair to say. I think it's one of the worst Federal Reserves we've had as an entity since the 1970s. It's atrocious. Tell me you're data dependent as we're getting hot economic data, and then talk about lowering the rate when inflation's already... Don't tell me you're data dependent. You're not. You have a predisposition and bias towards ZERP. I literally would tie the current Federal Reserve with the one that was as bad as the 1970s. It's that bad. Now we have, I want to say the disclaimer again, but I'm not going to. I'm just literally rubbing my eyes because I already know in advance I'm going to get accused of being in a camp. We have all of the tariff talk. Here's what I see on the tariff front. I don't see... Okay, how do I organize my thoughts here? Because I didn't come up with an outline as I should, and I've been taught for 40 years. All right, let's cover a few topics. First of all, on tariffs. Do I think the entire thing could work? In other words, what I believe the overall plan is to move to more of a tariff revenue basis, relieve, and this is just from what I've heard from the... I'm not saying right or wrong. I'm saying this is what the plan is. Relieve a lot of the burden on the taxpayer that's paying taxes on top of taxes to pay for the taxes on top of taxes. Let's have some of that revenue come from tariffs, and then maybe we can relieve the taxpayer. And do I think that could work? Yeah, absolutely it could work. Anything can work. You give me a trading model. I was talking again with a business partner. It just reminds me, when I'm talking, it reminds me of other conversations I've had, right? That's why I bring these up. About trading programs. And, I made the comment to him, anything can work, really. It's all in the nuance and how you do it. And thus, I have sort of a truism that I like to say, a maxim, right, that I like to say, which is everything works and nothing works. It's all in the nuance of how you apply it. So could that whole plan work? Yeah, absolutely. It could work with the right communication, the right policy, the right pace. And I'm not speaking politically so that this party wins or anything like that. I'm saying, could it work? Yes, it could. It's got tremendous challenges. The horrendous education level that's within the United States is one. The sense of entitlement that's within the United States. And I'm talking about even people, and I'm going to use my politically correct term, people on the lower end of the income distribution. You hear what I'm saying? People on the lower end of the income distribution. That is my politically correct terminology. I will play that game if I must, even though I'm Generation X. I will play that game if I must. I have a sense of entitlement. They really do, for what they expect. I think the educational standards in the United States are atrocious at best. That has to do with adhering to this silly Prussian model instead of human guidance on human Socratic self-learning. But that's a whole other topic that I could explore, but I won't. Can it work, though? Yeah, it could. It would take a lot of thought to make it work. And a lot of really good communication. Just timed perfectly. And so, yeah, tariffs could be used in that manner. Paced and applied gently and properly. That is not what we've gotten. I look at communication, and I'm not going to say political parties or anything like that, because again, the disclaimer. I look at patterns and what I see in front of me, and I have to believe what I see. I think of December of 2018. So for those of you who know what December of 2018 was, the market officially crashed with a negative 20%, and a lot of that had to do with institutions having a stranglehold on themselves. People that are like, oh no, the consumer this and the consumer that. You are objectively wrong. What the mechanics were going on underneath this, because institutions pretty much rule the world, is institutions had been strangled by regulations and had to keep so much tier capital in place. And when that limit had been reached, they had to start selling assets to maintain capital levels. And when you look at the communication that came out of the administration, it was badly timed. I don't think they had a real understanding of what was going on and why. And there was not a sensitivity to understanding how delicate at times market communication has to be and perception. And during the worst of it, they tried to communicate, and it was the mother of all backfires. So I think of that incident. And then I think of recent communications. Now, I will say this. Some people have critiqued the administration as far as communication, and some of those critiques against the administration I don't see as fair. Oh, now they're doing this, and now they're doing X, Y, Z, and now they're doing ABC. And again, the disclaimer, my side is the side of making money, and I need to know what's going on. So I go back and I listen to the source, right? So I see, oh, the administration's completely reversed course and blah, 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 blah. Okay, has that happened? I'm not discounting that it could. And I go back and I listen to the administration statements, and I don't see any reversal of course at all. So I have to filter all of that junk out. Some of the problem is the public. I'm going to be quite honest. A friend of mine said this, and I got to believe it. And I believe it's true of myself. Human beings, many times, it's going to sound really brutish and rude, are too dumb to be allowed to have an opinion. Human beings at times are too dumb to be allowed to have an opinion, and I include myself in that number. Because I understand that understanding initial conditions is exceptionally difficult to do because of the limitations of our observational powers and how we get information. That's why I'm trying to be very careful. Dan's very careful in what he says. Yeah, because I understand the limitations of human observation. Have you ever heard two witnesses who give their testimony witnessing the same event give conflicting? It seems like they're contradicting each other. They're actually not. That's a well-known problem with observation. It's literally referred to as the Rashomon effect. It has a literal name to it. Okay? So I understand that. So I include myself, and sometimes I'm too dumb to be allowed to have an opinion. But people get on there and like and share, and this gotta share, be the first one to share information without maybe a proper 5-axis verification of the data, which I try to do, but I could screw that up just like anybody else can because I have the same weaknesses as every other human being. So some of the problem is just the means of communication today. That whole social media, whatever I got to do to get an impression and a like effect and a dopamine hit from getting that. So having this feedback cycle to where the stuff that gets out there is not accurate. And that becomes wildly difficult to untangle. But as well, to be fair, what I see from my personal limitations is I see the communication has been bad. To come out and say we're going to fire the Federal Reserve chairman, what's that going to do? He doesn't have absolute power. He's a figurehead of the entire governance system, made up of 12 governments and hundreds and hundreds and hundreds of people beyond that. Thousands. Is it thousands? I don't know. But it's an entire networked system. And the chairman does not have some sort of executive veto power of, no, we are absolutely raising the rate, and I say so. And the other 11 members can look at him and say, no, we're not. It's not the chairman. Although I think I do know that the chairman is in agreement with the rest of them because they talk about their discussions and how they're in agreement. And it's like, you guys are out of your mind. But why would somebody come out and say we're going to fire him as if that's going to do something? My first question is, wait a minute. Don't you understand the Federal Reserve System? Shouldn't you? That's not going to do anything. And anything beyond that, although it can happen, that could happen. As far as the Federal Reserve's mandate, that's up to the legislature. That's up to Congress. So I don't know. Now, the fiscal side of the house, right, and the executive can use tools of language guidance. They can use tools of pacing and timing and good communication and understanding the sensitivity of markets, to where if the Fed is operating in a contradictory manner, and I've seen that before out of administrations, they sort of go a different route and steer their ship, the best they can. But this whole concept that we'll just fire the Federal Reserve, it's like, first of all, why would you communicate that to markets? Because it does nothing other than communicate to me you don't understand how the Federal Reserve works. So now I'm worried. Don't assign me a thing. I'm just saying to make decisions based on what I see as policies. How do I make decisions around that? The other problem is many guys who like to play at global macro, and we all do it, I'll include myself in that number, even on the institutional basis, and I'm just going to go ahead and say it because I'm me and sometimes I'm blunt, the data they're using and talking about like is very linear, very additive, and quite frankly immature. It does not show and reflect a proper understanding of going beyond trading programs, and are they robust enough to take price matching efficiencies and volatility compression and things like that. If we're going to talk about actual global macro, releasing a linear chart, talking about a linear output, and then talking about a linear outcome is the same conceptualizations that got us in the 2008 mess. Please tell me that if you're actually talking about real global macro, you're not using some linear model and you're not using some chart to prove your entire thesis of a one-axis chart. Like, please tell me you're not doing that, right? Again, as I say, right, if you were to ask me about my sort of approach and heuristic approach, it's simple, right? Would be very Bayesian probabilities, where I look at splines and sort of a if we're gonna use mathematical terms, sort of a polyharmonic spline interpretation for a Bayesian probability outcome. Okay, so what are you saying there, Dan? That sounds like you are but very involved. What we're saying is we have to evaluate many different scattered econometric data, sort of congeal them into seeing how close do they get and what do they agree and what sort of picture are they painting right now, and what does that dictate for the very, 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 very near-term probabilities, right, on the current, and you sort of construct a spline out of that, or where we stand right now, right? And you move that into the future. And and then there's other dynamic nonlinear models, and I always use the case example of like you don't have to get into all of the transitions of prey, predator, Lotka, Volterra models that have been adapted to macroeconomics and multivariables on the end space, and you don't even have to get that complicated. Think about it in this simplistic of a manner. Is the system, when you look at the system, is it in equilibrium? Is it in shock? Is it in post-shock? Is it graduating from post-shock towards equilibrium or toward something more chaotic and complex? Broad topics, right? We don't have to go through a bunch of math equations. I never see that out of guys talking global macro. And I'm sorry, I will point to that as a legitimate complaint. I'm not a PhD economist. I read those who are. I read published literature. I read their models. I'm not that guy. I'm not the guy to write those models. I simply try to read them, try to understand them, and think about a mature way to look at the economy. Okay? And when I look at the economy as a whole, I don't see us as an equilibrium. And you have to understand, if you're listening to someone, and we told GTC Traders premium members this a while ago, and they're talking about forward earnings, if they're talking about forward PE, if they're talking about discounted cash flow, if they're talking about intrinsic valuation models, By the way, some of what I just mentioned, I use. Linear models aren't bad if you understand they're linear models, right? I use some of what I just mentioned. But if you see people referring to such things and saying, that's why it'll all be okay, or these models show us that it's not going to be okay, it's going to be a chaotic disaster, you're listening to the wrong people. Because just like 2008, and what I think Margin Call displayed so excellently, is you have to think about, and this is what we told GC Premium members recently, what's the assumption with those models? All of those models are linear. And all of the presuppositions and assumptions behind those models have just flown out the window. We don't know what the tariff situation is going to finally look like. We still don't know. We don't know what revenue collection in the United States is going to look like. We still don't know. We don't know about tax breaks in the future. How are you going to tell me what forward PE looks like when all of the base underlying assumptions that go beyond those earnings estimates have just flown out the window? It's the same mistake they made in 2008 of using a Gaussian, copula, linear model for risk assessment and thinking that, we can look at this one asset class, boil it down to one number for assessing the risk, and not understand that during risk events, all distributions are nonlinear in nature. Okay? In other words, we don't know what tariffs are going to look like in the end, and markets hate uncertainty. We don't know what revenue collections are going to look like, what tax breaks might look like. We don't know. And if it's one thing equities markets and markets in general specifically detest, is uncertainty. So when I look at everything together, my state right now, and I put this in the Twitter stream, and I'm going to say it myself, utter confusion. If you came here thinking, well, Dan's got a really good track record for macroeconomics, and he's gonna lay it down what he sees, and that'll paint the clear picture, and we'll just go make our own decisions. I'd love to help you out. I don't know, because I do understand a lot of the models that are used are linear, and a lot of the base underlying has been tossed out the window, and we have so much uncertainty as to the system we're in. I've got a really good track record. I've been doing this for nearly 30 years. And I don't think I have ever looked at the state of things, even as a brand new trader, and been more confused. I don't have a clear picture even of initial conditions. When you're playing chess, sometimes, and I'm not the world's best chess player, but I'm just going to use this as an illustration. Sometimes when you're on the attack, sometimes it's good to remember, you can back up. You don't have to be pressing the attack all of the time. You can stop, pause, sort of build a line of defense, and maybe even work back to sort of redistribute your lines a little bit. Same is true in jiu-jitsu, right? You don't always have to be pressing forward. You don't always have to have pressure. You don't always have to be working an attack angle. You can stop. You can stop and retreat a little bit. In wrestling, Greco-Roman wrestling, right? You can stop. You can retreat a little bit. You can, figure out a new angle, right? There's no shame in that. Same is true here. I feel no shame for saying, I wish I could tell you. In 30 years of doing this, I have never been, if you want to talk about the state of things, state of the nation, what is it? Wasn't there a New Order song or something like that? Confusion. I don't know. If I look at risk at the moment, and this is what we've told GTC Premium members, is I would describe the system right now as post-shock non-equilibrium. Starting to shift to more and more chaotic state. And if we're just going to talk about my discretionary feel, right? There's quantitative, there's qualitative data, and there's discretionary. My discretionary, like instincts, we're talking, when you say discretion, you're talking more instincts. I'm not encouraged. I don't have a good feeling moving forward. Because I look at communication methods, I look at the pitch pace and means of communication, the insensitivity of communication on many fronts. I'm not blaming the administration or anything like that. I'm not the Fed, you name it. Now, I'm blaming half of you yahoos liking and sharing stuff before you 5-axis verified it. Before you've objectively looked at the data and tried to weed out stuff that's false. I'm confused. So that's the state of things. Okay, that's what we have to say. We will continue. So what do you do in this state, Dan? I definitely don't believe that the Federal Reserve is data dependent, nor do I believe they are serious about inflation. I do believe, just like 1977, if we get output gaps because of supply chain problems, they're behind the power curve. Oh, wow. Look at that. Another case where the Federal Reserve is having to play catch up. And I would have no doubt that in the future, if they would get a hold of any inflation that may come about, they will look to be cutting way too quickly, as they exist right now. I don't like the communication I'm seeing. It's better sometimes to say nothing. You know, communication is a very, very nuanced thing. Sometimes it's better to say nothing than to open your mouth and cause panic. Other times, saying nothing is the absolute worst thing you can do, right? December 2018. And then when you decide to say something, it's not particularly reassuring. So I'd love to know what to tell you. I'm just going to continue to what we have now. I'm not making decisions based on my global macroeconomic read. Hey, I think valuations are here. Hey, you know what? Just buy it all up. I understand the base assumptions behind valuation models. I can't rely on those. Beats me. I wish I had more encouraging news for you, but beats me. I'll even let you know how we are playing things. Very, very, very carefully. A lot of treasury bills. I've been loaded up to the gills on treasury bills, and what we like to do is when we had trades on, we don't have any short-term trades on at the moment. Not a one. And this is something I would tell people if you're interested in GTC Traders, GTC, the premium report, which is just looking over our shoulder onto 3 models specifically. Sometimes trading isn't sexy and there's not a lot to do, and it can be insanely boring. The right move can be insanely boring to make. And I think we're in that state right now. And I'm not in the mode of like, no, buy it all up. Time's to load up on risk. I am very risk averse at the moment. Been enjoying discount to yield very, very much lately. If you do make some trades, make them small. Make them small because it's all about capital preservation. And I would love to see a picture either on the fiscal side of things or the monetary side of things become more clear. But I also listen to those who work at institutions and talk with them, and they're all feeling the same thing. You know? God, I see what I've seen go on in short-term interest rate markets is just wow. And I'm talking more curve relationships. Like, holy, look at that thing go. I think I'm going to close with this. I think if you could describe the entire global economic market in one word picture, right? Ancient languages like Koine Greek would have words that they used as a word picture. And a word picture is something you can put in your mind to sort of think about a scenario, picture it with a metaphor. Think of a poker table. Now, at a poker game, you have to trust your counterparties. In other words, when somebody puts down the chips, you trust that they have the cash to back those chips up. We'll call this trust in your counterparties or counterparty risk. Maybe you don't trust them. Do you really have the cash to back up those chips, right? And when there's a global risk-off event, generally it's a liquidity event. In other words, everybody gets real nervous and backs up. When you're at a poker game, and something's happened where you don't trust the other people at the table, everybody backs up off the poker table, right? I think if you look at the entire system, we have a very, very, very nervous poker table. where everyone sitting at the table is very unsure of their counterparties and what's going on in the room. And I think we are that. If you want me to describe initial conditions, that's how I would describe them. That's why I say I think we're post-shock non-equilibrium at the moment. And now which way we slide towards that, I'm not very optimistic. I think Bill Gross had a tweet where he said, what's being proposed can work. The United States has been through many shocks before, right? Great Depression, 2 world wars, going off the gold standard. And that's what Bill Gross has likened to this whole scenario to. He says, I think this is as big as going off the gold standard in 1971. So I think we're at a poker table where everybody's real nervous. I've looked at order flow where it's like we'll get near some case prices and you can almost see market makers and everybody else get super light and not want to commit anything, and the book just goes. I mean, it just does. In a way that did not happen previously. Okay. Wish I had better news for you, but that's sort of the state of things. I think the initial conditions are we are dealing with a situation where if we think of the global marketplace as a poker table, everybody at the poker table just got really, really nervous about counterparty risk, and not even counterparty risk. Banks are fine. They've got tier capital, but like, what the heck is going on in this room? Post-shock, non-equilibrium. So that has been our thoughts. Hopefully we can do more of these. Maybe I won't go on as long with them, but hopefully we can have more in the way of public content. What we're going to do with this podcast is we are going to release it first for premium members, let them listen to it. A few days go by, then we'll release it to members of GTC Traders on the Patreon page so everybody can listen to it. And then probably a few days after that, we will release it publicly for everyone. Okay? So if you are hearing this later, could be a year down the road. These things are evergreen. If you are hearing this podcast later, who is GTC Traders? We're a bunch of guys, right? We're a bunch of traders. Many of us have been doing this for a long time. I've been doing this almost 30 years. Other partners who aren't necessarily the front men, they have other tasks on this particular brand. They have even longer. Some have been going longer, 35 years in. Collectively, I think when you look at all of our experience, whether it's trading, whether it's management, whether it's securities law and securities compliance and things like that, I think there's over 100 years of experience. And looking at all of that, we hope to do more publicly. We hope to do more podcasts. We hope to do more in the way of free education out there, sort of replicate what I did personally before with Sharp Trade. We do hope to do that now that my time is freeing up, as we were saying earlier. And join Patreon as a free member. It doesn't cost anything. And what we put out there publicly for free, you'll get notified on. There's also a premium membership, and we've already described to you. That's a look over our shoulder as to every morning on my private proprietary firm. We have a morning note of just what we think of markets at the moment. It's not actionable. It's market awareness for all of the reasons that we mentioned previously. We put that out there. Not sexy, not exciting, not flashy, not looking for engagement, but real. And then at the end of the day, we look at our portfolios, our programs, and is there anything we're doing in this program? We get into even some of the reasons and rationalities. Why has Dan been playing so knit and so conservative for the last year? Right? There's links in many of the posts that we do each day, and if you follow that link, although the links aren't colored well, they should stand out to be a better color, I think. But regardless, if you follow those links, there's some article series like, why do we believe that we started in a bubble in November of 2023? What are the quantitative, qualitative, and discretionary feelings behind that statement? It's not the end stage of a bubble, but you never know when a bubble is going to burst, right? Why then are we playing such a conservative game in this environment? What's our thoughts on performance during that environment? We're outperforming the SPOOs this year at least, but we weren't in the previous 2 years. Well, why, right? We get into some of our thoughts and rationale. We hope to do more of that in the future as well. And that is the premium product, Read the Report for GTC Traders, and it's $15 a month. I swear to God, the hybrid core equity fixed income model, in other words, new retail traders call that dividend investing, although it's sort of a retail term. If you look at that, the income alone, forget the thousands of dollars we've applied to a very, very tiny $50,000 sample portfolio that you just look over our shoulder. It's not advice to what to do. It's just a look over our shoulder as to how we think about portfolios. If you look at just dividend income, it's greater than $15 a month, and that's not even counting the thousands of dollars and capital gains we've had. And by the way, our trading hasn't been perfect. We've been playing net, we've been playing conservative. If you don't like it, play more aggressive. I'm not telling you how to trade, right? But for those that like to look over, I always wanted that, quite frankly, when I started. It's like, God, I just wish I could look over somebody's shoulder and they could talk through their process. And so that's what we do, right? There's also that out there for you. There's GTCtraders.com. There's the GTC Traders Patreon site. And hopefully there's more in the future in the way of podcasts. And for now, that has been our podcast on the state of things and has been what it's always been. It's not advice. It's just our thoughts, right? Which are good until canceled and have just been our thoughts, not yours, for whatever the heck day it is. As always, stay safe, trade well, and remember that love doesn't cost a dime.